Imagine investing in the world's biggest companies: Apple, Microsoft, Amazon, Nvidia, Google, all with a single click. Sounds impossible? Actually, it's one of the easiest investing strategies used by millions of Americans. It's called an ETF, and if you're serious about building long-term wealth without constantly picking stocks, this might be the smartest investment you'll ever make. Stay until the end, because I'll show you why many millionaires recommend ETFs over individual stocks, and how you can get started with as little as $10. ETF stands for Exchange Traded Fund. Think of it like a basket filled with dozens, hundreds, or even thousands of different investments. Instead of buying just one company's stock, you buy one ETF that owns pieces of many companies. Imagine ordering a fruit basket instead of buying only apples. If one fruit goes bad, the whole basket is still valuable. That's exactly how ETFs reduce risk. For example, if you buy an S&P 500 ETF, you're instantly investing in about 500 of America's largest companies. One investment, hundreds of businesses. That's the power of diversification. There are three big reasons investors love ETFs. First, they're diversified. Owning hundreds of companies means you're not depending on one business to succeed. Second, they're low cost. Most ETFs charge extremely small management fees, allowing more of your money to stay invested. Third, they're incredibly simple. You don't need to spend hours researching stocks or watching financial news every day. Just invest consistently and let time work in your favor. That's why many financial experts recommend ETFs for beginners and even experienced investors. Let's say you invest $300 every month into a diversified ETF. If the market averages around 10% annual returns over the long term, your investment could grow into hundreds of thousands of dollars over several decades. Not because you got lucky, not because you found the next Tesla, but because you stayed consistent and let compound growth do the heavy lifting. This strategy may seem boring, but boring investing often creates extraordinary wealth. Now, here's something many beginners misunderstand. ETFs are safer than buying a single stock, but they're not risk-free. If the overall market falls, your ETF can also lose value temporarily. That's completely normal. Successful investors don't panic during market crashes. Instead, they continue investing because market downturns have historically been temporary. The biggest mistake isn't market volatility, it's quitting too early. If you're looking for a simple, affordable, and proven way to build wealth, ETFs deserve a place in your investment strategy. Remember, you don't need to predict the next big stock. You simply need to stay invested long enough. Your future self will thank you. If you found this video helpful, hit the like button, subscribe for more smart investing content, and comment below. Would you rather invest in individual stocks or ETFs? See you in the next video.